on LinkedIn and on YouTube and on Riverside, where we're currently hosting. You can use those chat boxes to ask any specific questions. So if you have a question that's specific to your situation, you're welcome to ask it. Obviously, we can't have you like upload a model and tell us to go into it or anything crazy like that. But Kian's here to walk us through kind of best practices for a model. We're going to spend a little bit of time going into a presentation, like just things to keep topical and thinking about your model. And then we're actually going to spend some time actually in model real models that were used for real businesses, just anonymized for privacy purposes, but they'll be very applicable to how you might want to consider your business. So it looks like we're live on all platforms. Should be good. We still have a couple more people trickling in here. So I think we might be good to go. Yep. All right. Yeah, we've got about 18 people across platforms, now 20. All right. So, Kian, welcome. We're gonna go ahead and get started here. Thanks for joining us today.
Yeah, thank you very much, Jason. It's nice to be with you. And before we get into kind of the mechanics of the model and sort of who it best serves, I know everyone's dying to see the real life example and all that. I first wanted to give some background about myself. As the bio stated, I've spent 10 plus years in the capital markets. First did investment banking, sell side, buy side representation for M&A transactions, as well as a little bit of IPO capital raising. Did that for some time. After that, I actually did hedge fund work in public equities, where our process was very much dependent on constructing models and meeting with management teams. And basically, our edge was trying to create a better mousetrap, when it came to having a model and trying to find discrepancies in earnings and revenue. So did that for 5 years. In 2021, I actually wanted to hit the pause button and wanted to change. So I've taken that decade plus of experience in capital markets, investing, and now I'm with Chelsea Capital as a fractional CFO, trying to bridge that gap with entrepreneurs and operators and VCs, as people are in the audience, and really trying to understand and bridge that gap. Oftentimes what get lost in translation amongst language between operators, entrepreneurs, the people that are actually doing the day-to-day versus kind of what the investors and even the financiers, the sources of capital, how they perceive opportunities and risks. And so been doing that for about 2 years, developed a good roster of clients and many models under our belts, some good, some not so good, but that's why we're here with you. So that's a bit of the background. I will share my screen and get into the presentation. Hey, Jason, I think you're muted.
Oh, wow. All right. I've been talking for a minute there. My apologies, everyone. All right. Well, we're going to go ahead and kick things off here. Thanks for the introduction on your background, Ken. Really appreciate that. As a quick reminder for those that just joined us, my name is Jason Kirby, founder and managing director of Thunder.vc. We're a tech-enabled investment bank that uses AI and other services to help companies raise capital from the right investors. And we have Kian here today, who's given us his background as a fractional CFO at Chelsea Capital, a firm that helps startups do their accounting and financial services and fractional CFO type services. And really, we're going to be diving into what you should be doing as a startup and as a founder when it comes to packaging up your model. What are the things to keep in mind? What are the things to take into consideration? And we're going to spend some time actually going through real models and giving you some applicable advice on things to take away, from the experience, from the session. As a reminder, we have chat boxes in all platforms, regardless of where you're watching. Looks like we have some chats coming in. And we look forward to hearing any questions you have. I'll make sure to ask Kian those questions as they come up. But Kian, I would love for you to go ahead and jump right into your presentation and start sharing your highlights and key takeaways on what founders should have in their financial models.
Yeah, absolutely. Thanks, Jason. Can everyone see the presentation on the screen?
Yes, you're all set.
Okay, great. So like I said, went through the background and sort of the agenda, or some of the items that we've sketched out for now is just, the obvious points. Why is it important to have a good financial model? Who benefits from a good model? Oftentimes, during the fractional CFO role, I've seen that operators have a very good business and have reached scale and milestones that you wouldn't have thought without sort of having an operating model. So oftentimes that sort of catalyst for a model is external financing or a new investor on the board or something like that. So we want to sort of pivot and have those conversations earlier, and we'll get into reasons behind that. And then the actual technical side, like how to construct a model. And as Jason has mentioned, I'll share my screen and go through an anonymized model that we've constructed that I think hits on a lot of the points that have been well received from the entrepreneur, but also sort of the financing community. And then sort of the flywheel effect, or the linchpin to sync it all back. What are the best practices for incorporating and maintaining the models, right? You spend all this time and effort up front, scrubbing, your accounting teams to create accurate historicals, spend all the time working in Excel and PowerPoint to create a model. Well, you don't want to just let it collect dust after that initial fundraising round or whatever you needed it to stand it up. You want to keep tabs on it after time and understand how it can best work and implement into your process, which I think is one of the more important aspects, actually. So the importance of a good model, right? I mean, the obvious are it provides for accountability. As an operator, you set a goal and you lock in a budget. You want to quantifiably measure your results over time and be able to compare that to what you thought it was going into the year or in the quarter or the month or even a few years. And by having that quantifiable way put down beforehand, you can then compare your results and find sort of the reason for the delta. Was it users? Was it price? Was it some new competitive entry? Just more of a way to maintain and keep records. And then another important is just dashboard monitoring. I mean, we'll get into this, but I think very successful operators have a very good dialogue with their board of directors. And that doesn't mean that it's only when times are good. Often some of the best setups are that have been fostered through the hard times, where the entrepreneur or the management team was forthright and open with the board during those difficult stretches. And because of the model and the dashboard monitoring, they were able to articulate why there were some struggles. They were also able to pinpoint those ahead of time, which I think is, we can all sort of realize that that's a very good attribute to have in communication. But they were able to pinpoint these ahead of time and develop that sort of rapport with the board. And then this is kind of the underlining part of having a model and bridging that gap between entrepreneurs as well as sort of the sources of capital. It's a way to better articulate your story with the supporting numbers, because at the end of the day, I don't want to sell what I've done for 10 plus years too short, but it's basically a story. How are people going to buy in or believe into your story? You need to have supporting numbers with those assumptions and then be able to articulate your assumptions behind those numbers. Why is it taking off? Is it new product? Is it new sales force? Things like that.
Yeah, Kian, I just want to emphasize that a little bit more, especially as we have a guest here asking, like being based on solely assumptions, especially if you're early stage, maybe you don't have revenue, or, you're kind of getting something off the ground. Something I'd also like to add to what you shared there is like kind of try to break down unit economics. Do your unit economics scale? And you might not have perfectly defendable numbers yet because you're too early, but as a founder, you still want to have a strong idea and be able to defend your thought process on, okay, if you sell a widget for $100, you're expecting a gross profit of 80%. Like, you want to make sure you can defend that and, show how that scales, across the model over a couple of years. And so that's just something that I always like to see in models, especially in the assumptions tabs, or, part of the model is, how defendable are the unit economics of your model? How do they scale? And do I believe you? Obviously every model in most cases, especially if you're early stage, is, full of, made up stuff. You got to start somewhere. But it's more about like, how are you thinking about it? How granular are you thinking about it? What is it helping you identify that might come up in the future? Like, what investments will you have to make that you might not have thought of otherwise if you didn't have to map it all out? And it also just creates a really good dialogue, as Kim was saying, with your board, investors, advisors, because when you tap into their experience, they're going to be like, oh, well, why don't you have these 4 line items? And you're like, oh, I never thought about that. And you get to add those in. It changes how you think about your business. Like, oh, maybe we need to ramp up marketing sooner. So it's just a really practical thing to have. And a lot of founders, I feel, don't want to do it because, like, oh, it's made up anyways. But it's such an important exercise for the business and the founders to go through, especially before they really start ramping things up and trying to hit any kind of level of scale. So, Kian, I'll hand it back to you.
Yeah, no, that's a great point. Thank you, Jason, and thank you for that question. And I understand that there's sort of different audiences, right, where the model can be viewed as less applicable, especially so early on in the life cycle of a company, which I understand that point. And the counter to that is that if it's a courtship process, right? When you're going to try to get financing, they want to have faith in you as an entrepreneur, as well as the vision and the opportunity for the company. And if you they speak in models, they speak in numbers. It's unfortunately a different world at times. And if you can put your best foot forward, meaning a professional looking model, I, I hate to say this, but I think oftentimes it legitimizes your idea or your concept, and then they can have that conversation from there, and actually the conversation that you want to have, right, about your vision, about how you're disrupting whatever you're disrupting, or how things you see playing out. So I think that's really important. And then the other side too is I fell prey to this earlier in my career, that when you present a model to an investment committee, a bank or a VC or whoever trying to, or as an exit strategy, whatever you're presenting it to, there's that natural inherent conflict, right? You're trying to present the numbers in a rosy picture as a seller. The potential buyer is trying to poke holes in that to get the price lower, or just they're just naturally skeptical. So I think by going into those types of conversations with that ground level mindset, you can leave the defensive nature at the door and understand that they're not trying to be argumentative. It's just there's a natural friction and conflict, and they're trying to ask questions to better understand what's behind your numbers. And if you have that idea or that mantra going into it, you can answer the questions forthright and in a good way. And then you can sort of riff and get more to the qualitative side of things that are about highlighting the business. So I think those are a few things fundamentally, especially early on, like early stage pre-revenue, seed fundraising side of things. So I'll go to the next, and this is who stands to benefit from the model, right? It's the operators. Oftentimes, operators have, in my role as a fractional CFO, have come to us and like, I just passed $1 million in ARR. I kind of had a lottery ticket in this idea or product, but I didn't really have a model. I'm not great at numbers or finance, but I'm great at risk taking and entrepreneur, which is awesome because those are things that I'm not great at. So it's an envious position to be in. But so it's then okay. Well, now I've kind of I had an interim loan or a bridge loan, I had my seed capital, but now I really want to take the next step. And the roster list of investors that I'm seeking are a little bit more sophisticated and require, you know, a larger amount of financial information, historicals, as well as projections that and KPIs that I don't necessarily have. So let's get to work. Great, we can help you out. But what I will say is, if you have that information from the beginning, even if you're only doing $20,000 in revenue annually, it's just that process and steps that you've built from the beginning will help you, one, probably scale your business much quicker and think about things differently and see things sooner that are happening kind of in the periphery in the next couple quarters. And then two, it's so when you do have to make that leap to kind of spruce up the cap table and speak to more sophisticated investors, like you're already set. You've been doing it for a couple of years. It's not like trial by fire or drink from a fire hose. While you're trying to fundraise like a seed two or series A or something that's more serious. So I think that's really important from the jump. And then just, I hit on this earlier, but the providers of capital, like they're used to seeing models. They read in financial statements. They're very quantifiable people, skeptical, like those types of behaviors actually at times make good investors, as we all know. So I think a good model can help streamline that process and really get it off to the right foot. And then the third point is, the owners and board members, and this oftentimes is an afterthought, but it's a really good output of the model. And again, an ability to leverage all of that front end work that you've done to create the model on the fundraising side. So oftentimes, what I've seen, like I said, with good models is they've I don't want to say pivoted, but they've created dashboards and quarterly variance analysis where, okay, with my board, they care about these three KPIs. And they care about these three KPIs because when I raised capital with my model, these were the three KPIs that I said I would deliver on over a short term, medium term, long term goal. And these were the KPIs that would help me realize whatever I'm trying to accomplish. And by setting up that dashboard on whatever cadence you agree on with your board, it's a way to easily populate those numbers. And then what I find, take it another step, what I find really helpful is once you lock in that budget at the beginning of the year, beginning quarterly, however you treat it internally, you can then lock in those numbers and compare it to how the actuals actually came in. So you can see if you're underperforming, and why is the most important thing. And by doing that, you can then make more real-time decisions to allocate something in an area differently, or potentially perceive obstacles a few quarters in advance. And then the last point is, the press and the media. This is more of a softer point, but I do think by having kind of more of an idea of your numbers, you can then sort of push these out to press and media like Jason themselves, but highlight, XYZ company just grew revenue 400%, ARR, whatever, inflected to profitability. And by having a model, you can then sort of be able to quantify that and show that to the press and media, which is good.
Keen. So one thing I want to kind of share on this point is what's the product that's sent to each of these people? Because the model is the base functionality. And this kind of goes to another question that came up from Faisal. What's best practices when it comes to like a really complex model versus a simple model? What do you end up sharing with a VC versus your board versus, press? Like, and something that I like to kind of use as a rule of thumb is there's a model. That's what everything's built on. That's what you kind of factor in historicals with. There's, and then you kind of have your assumptions projecting out, a couple of years, depending on your scale of business, at least a year or two minimum, if not 3 years, on all models would be kind of the safe bet. But when it comes to what would you share, My best recommendation is, and I'll be curious to get your thoughts as well, Kian. In a deck, you want to have at least projections of just like what are your key KPIs. So is it number of customers, if that's like your core like growth of customers, and then you look at like top line revenue on an annual basis, and then you have what's your margin or your COGS to deliver that service, and then kind of your general an administrative cost, and then your net operating profit or cash coming from the business, to keep it real simple from like a introductory, you just met these people. But from an insider or something, like maybe you're in deep discussions or diligence with a VC, you want to have that full comprehensive model to be able to dive into, have conversations, be able to have a dialogue around it. Impressive media definitely don't want to send the whole model. Maybe just a couple of like, here's what our growth was, and it's more of like reference. You can't really put forwards, forward thinking or like projections into kind of public materials in a lot of cases, especially if you're raising money. But I'm curious to kind of get your thoughts when it comes to you as a founder sharing a model with a VC. How manipulatable should it be from a VC perspective when handing it over, and how much can how complex should it be? Should it only be presented, or should you be able to hand over your entire model to a VC and let them run wild with it? Kind of what's your take on that?
Yeah, no, it's a good question. And I'm not going to take the cop out answer, but it varies, right? I think in the beginning, I think a simple P&L output, like Jason mentioned, on a PowerPoint slide makes sense. Here's our revenue. Here's one or two of our biggest expense inputs. And then here's kind of our runway, cash burn, and then maybe one or two KPIs, whether it's users, ARPU, CAC, whatever may be uber important to you and your story, you want to highlight those. As things progress, you'll certainly share more. If they ask for the model, which they eventually will, I think what you want to have prepared is the model as in depth as you want to go. I mean, again, remember, as an operator, like your business better than anyone like me or a potential investor. Your business. Just, but it's that bridging the gap of trying to pull those super interesting KPIs that are in your head, pull them on paper, and put it in a language that those types of people understand, and be able to articulate that story. So that's the bridge we're trying to cross here. So you have a working model as in depth as you want it to be. I've seen oftentimes people literally port their CRM or Salesforce dashboards, right? Like kind of the sales pipelines, and just sort of do a probability weighted assumptions based off certain contracts or deals closing, or even just their weekly or monthly sales quota meetings, right? That's kind of their revenue drivers, just how they think about that. That is one way to think about the working model. And then on a separate tab, oftentimes I'll label it like P&L output, profit and loss output, which is basically your income statement. So that's the part that you're going to export to a PowerPoint deck, or what you see, when a publicly traded company reports earnings, and you see on when that earnings report hits after the market close, that P&L screen grab, that's what you're going to recreate on a separate tab. And that way it looks super clean, super concise. Anybody that has spent a few months looking at financial statements can easily understand what's going on in your business. But then if they want to dig a layer deeper, then they follow that cell to the next tab, which is kind of that where the magic happens in that working model side of things. Jason, do you think that answers that?
No, I think that's perfect. And I think that's exactly what I typically do in my models, and I highly recommend for most founders to consider. But there's some more questions, but I think it'd be good for you to kind of continue through the presentation, and I'll pick at when to bring these questions up.
Sure. So kind of in the constructing a model, and again, we'll go through a live tutorial of a model that we've created, but I just want to put it on paper. I mean, we get sort of really anxious about creating a model, right? Because it seems sort of hieroglyphics to us, a different language and complicated. But at the end of the day, I mean, like I said, remember, you know the numbers better than anyone else. You've spent more time. This is your baby. You know it better than anyone else. So think about the revenue units times price. No matter if you're selling dog food, if you're a consumer internet company, or if you're NVIDIA on cutting edge AI, like whatever it is in history or present, revenue generally boils down to units and price. So think about your business that way, because oftentimes investors will think about it that way. So if you're already speaking their language when constructing the model, I mean, you've already jumped over steps 1 through 3. The second point, we've hit on this, but identify really relevant KPIs that are important to you, but also these these are basically the vows that you're going to tell your investors. These are what you're promising them, that the journey that you're going to take them on the next few years and how you're going to make the business bigger. These are the metrics that they can see that show the early evidence that your business is on track to hitting why they gave you that capital a year ago or just now. So those are, think about it. They're really important. They can change, but if they change, I would always sort of, people get really suspicious of changing KPIs. So you might want to explain that, or at least keep the legacy KPIs in there as well. But I mean, these are vital to a really healthy model process. And then the third point, and this is what I'm going to spend a lot of time in the model tutorial, but scenario analysis and run multiple cases. I think this is important because as someone astutely pointed out, that, you know, models are only as good as the weakest assumption. It's a house of cards. It's assumption based off of assumption, and we all know things can change in a day. So that being said, you give yourself an out if you have scenarios and you run a lot of different cases. Too many times I've seen in fundraising rounds where someone, an operator, and rightfully so, has strong faith in their business and only presents one set of projections that are probably in their mind realistic, but to an outsider's view, probably a stretch goal. Like if that happens, that's a unicorn. That's awesome. So rather than sort of set yourself up that way, I think if you run multiple cases, and you can label them, we'll get into that, but you can still incorporate the case that you see as ultimately the what lays in front of your business. But by having multiple scenarios, you can sort of sidestep some of those landmines along the way. And then it allows, like I said, there's that inherent conflict or friction during these conversations. So by having multiple scenarios, it just calms the waters, because someone can say, well, I see your stretch goal. I understand that, but I'm going to, like, let's underwrite this deal more toward the base case, rather than just sit there and derail the negotiation or the conversations when they're just trying to poke holes at your upside case, or your reach goal. So I think that's just sort of important. And that again is be practical, set reasonable expectations, and then format and easy to navigate. I think with the model, oftentimes the providers of capital, when they ask for a model, are testing the waters, frankly, to see how serious you are. um, they get the model and they're going to do their own things. Oftentimes they might just, I've seen it where they've requested a model and we've spent months working on a model, understanding the business, and at the end of the day the valuation was done on the back of an envelope. But by having that model is sort of that goodwill that's developed, that, I mean, they're entrusting you with their capital. And so if they believe that you're this committed, that you've spent this amount of time with their model and you understand the business so well from a deep level, from an execution standpoint, but also from a high level, being able to present it in a model format, they're more likely to believe you, sets up great relationships, and then provide you with capital. And then that sort of develops that goodwill along the line with reporting back to them And it all stems from how is it received in the beginning. So that's that format, right type of font, just the width of I mean, that's kind of nerdy stuff, but the right width of columns and rows, and just the color coding and all of that.
Yeah, Key, and I'll talk to that just briefly there. When it comes to just the overall layout, once you kind of get through the chaos of getting your model together, and as Keaton was talking about, like my favorite place to start if you have it is start from your P&L and kind of work from there. But formatting wise, just make it clean. Make sure that the cells are readable and that people don't have to do any additional formatting or and also like coloring, using some color formats to just kind of identify headers versus inputs versus outputs, formulas versus just raw numbers. Being able to just kind of identify those with colors, and occasionally just having some notes if something needs a little bit more explanation, or you're kind of like pulling something out of left field, add a comment, add a note, so that anyone can kind of hover over it and understand a little bit more about it. These are usually final touches. Once you kind of start feeling good about the model. And yeah, that's from a formatting perspective. It just kind of makes things a little bit cleaner and easier, and it just looks more professional. And you can always step it up a notch by adding your branding colors as opposed to just the basic blues and greens that you might see. But Kean, I'll hand it back over to you to go to the next slide.
Yeah, no, that's a great point. I mean, when you think about constructing a model, it's oftentimes I compare it to building a home where you've got the foundation, which is like the working model, all the nitty gritty of it. And then, when you start doing the cosmetic stuff, the curb appeal is the formatting and the easy to navigate.
Yeah.
And then this is, so you do all that work on the front end to create a model. Um, you want to return on it, rather than just the fundraising or whatever it is from the upfront. But on the back end, I oftentimes this is actually where models become even more helpful, and pay for themselves, you know, way more than what it was from initially to stand up in man hours. And best practices here, what I found is update actuals on a consistent basis, whatever it is that the rhythm that you like to get in. And it sort of depends on, the staffing of your back office and your accounting. But oftentimes when you close the books, um, update your financials, see how the actuals are coming in. And importantly, though, if you construct a working model, oftentimes when you put in the actuals, your projections will change. And you can either like that or not have that function. But I think it's important to have a living, breathing model, because as your actuals are changing, you can say, well, this segment or my users really took off, and that, like, based off of signing more users up last month, well, that means like this month and in 2 months, my revenue is going to significantly go up more than what I initially thought at the beginning of the year. So you wouldn't know that if you didn't update the actuals and have like a working model. So I think those are really helpful. And I touched on this a little bit with the board of director reporting back, but the monthly and quarterly variance analysis, this is this is really helpful, and I puts you in really good graces, I've seen, with boards. And again, it depends on sort of the sophistication of of you and the board, but it's a really nice thing to have with the board where you compare, you set up calls on monthly, quarterly, and it gives you something to talk about. You compare what the revenue or those couple KPIs were going into the month, what you thought they were versus what the actuals were. And it can be as simple as, you know, in column A, total revenue. The next column, what the actual number was, 5 million. What you thought it would be, 4.5 million. And then, you outperformed by 500,000. And then in the last column, just a little comment like, well, why did you outperform? Well, we finally landed that big contract. And just by having that and calling it out, one, you give yourself credit with the board, which is awesome. Um, and then two, you can have those conversations with the board. Well, they'll be like, well, why did you win that contract? Are there some lessons there that we can apply? So it sort of is an easy thing to part of your process that you're already doing and should be set up just by inputting the actuals, but then feeds into the board reporting process. So you're becoming more efficient just by putting in the actuals and tracking your business. And then, I've seen it in the bad times too, where it's actually because you've been consistent and presenting the same KPIs in the good times, that when things sort of go sideways, or for a stretch where results are coming in below kind of what you were budgeting, the I mean, no one's happy, obviously, but it's a more respectful, constructive conversation. And oftentimes it's respectful and constructive, well, because you have the results, you can quantify and actually talk about it. But two, you if you're doing it in the right way, oftentimes you see these things bubbling up before it actually happens. So what we talked about, right? Like if users were kind of decreasing or coming in below budget, it may not affect revenue that period, but it'll affect revenue in the future periods. Well, you can pinpoint that if you have a working model and say, the users have decelerated a bit, the revenue's coming down versus kind of what our model had been at the beginning of the year. For the second half of the year, we either need to step up marketing spend or do something. It just allows those more strategic board level conversations to take place that otherwise wouldn't if you didn't have this sort of reporting mechanism. And the pricing analysis and solve for break even. And this is a good point where Jason talked about sort of the unit economics, especially for businesses that are sort of pre-revenue or much earlier stage. If you map this out, you can come up, and oftentimes I've helped with companies that are constructing a business case where they're going to sort of an angel investor, and there's not much revenue to show from the beginning, but by constructing sort of a map out of how the revenue flows through the business, or even through the market opportunity. If you want to start super high level as a TAM analysis, how big is the market? How much share do we need to get to a break even point? I've seen land really well, especially kind of pre-revenue, just when it's sort of more or less a thought on paper. So if there are any, Jason, I'm not sure if there are any questions.
Yeah, so I just have a couple questions before we dive into the models. So the rest of the time there. So one was, what is considered best practice when it comes to, financial modeling? Is it advisable to have all three statements? So like your statement of cash flows, your balance sheet, and your P&L, along with supporting schedules on the same sheet, and have the working model in there? Or should you have all your actuals and financial statements separate from the from the working model?
Yeah, that's a good question. It's called. There's two ways to go about it, obviously, and it sounds like the root of that question knows this, but for those that don't, there's called the horizontal model, which is across different tabs, where you have the working model, the P&L, the balance sheet, the cash flow, all of those things in separate tabs. And there's also some people like that because it's easily organizable and people can navigate it easier. There's the vertical model where everything is on one tab, and how to separate that is you create what's called an elevator. So in column A, you put big X's, and you can just scroll down to find the P&L, the balance sheet, things like that. So it's a personal preference. I prefer the vertical models just because I like things. It seems simpler for me to stay on one tab. But a word of caution is, if this file will be shared amongst people that aren't as familiar, oftentimes the horizontal is your best bet, at least initially, because they can easily see and identify P&L, balance sheet, customer list, whatever it may be. So it's personal preference, but if you're just starting out, probably the horizontal across different tabs. And then the more specific balance sheet, cash flow, again, it depends. If you have the resources and the capability to stand it up with all of those items up front, absolutely, because it makes you more serious about the financial reporting. But it also, I've seen, it gives you a longer look back period. So like when you go to fundraise, if you're planning on fundraising this time next year, and you just, if you stand up, the earlier you can stand up a model and the more reportable historical information you have, the more credibility and integrity your model will have.
And it just also depends, in my opinion, on what you share and when. Like, if you're in later stages with negotiations with a VC or an investor, I usually like to have historicals all in one document, just for quick navigatable. Like, if I, because I do this all the time with our clients, like I need to validate, their financials and make sure that the story lines up. So I like to see historical P&L with the latest balance sheet and statement of cash flows, in all in one document to kind of quickly go through. I usually like the model in a separate document, just because I just need to look at the actuals, what's going on, make sure that's all good to go. And then your model, assuming it's a working model, you have a little bit of your historicals, and then you have your forecast. But that said, I would love for you to just kind of spend the rest of this time kind of showing us and sharing the models that you kind of brought to the table to kind of walk people through what to expect and looking at a model.
Yeah, definitely. Thanks, Jason. So bear with me. Let me share my screen here.
All right, we can see it.
Perfect. So first things first. So we were tasked with developing a model for basically a consulting company. She has had tremendous success. Just kind of an idea, and it worked out. But she felt like she wanted to take it to the next level and potentially, for one, I mean, pay herself more of a market rate salary, given where the business had gotten to a point. And two, um, she felt she wanted to develop some medium term and longer term financial targets, that something to set goals to and tie sort of bonuses and compensation for employees, but also a potential exit strategy. Um, so we were tasked. I mean, she didn't have an operating model prior to working with her, so we took her actuals from QuickBooks and ported it into this P&L. And before I get into some of like the more functionality of it, I want you to notice the formatting. So on the tabs, you can you can see they're clearly labeled, and then this is like a breaker. So anything after this is kind of actuals from the company. Um, so from there, it's easily navigatable versus what you want to see. This is all personal preference, but we've got the annuals color coded in nice, neat columns so that you can easily navigate. Um, it's kind of industry parlance, but actuals are in black, so that way they just know that it's in the history, that it's actually been locked in the model. The projections are in blue, and in this case, green is pulling from a different sheet. You can follow it if you want. The grays are formulas. And that allows me just to quickly bypass them, rather than like know that they're drivers, and which leads me to the blue, which are hard coded drivers of the model. So here, this is the P&L, just a quick and dirty view of the P&L. And what she wanted to know is she had $2.8 million in revenue in 2022. She wanted to know what it would take and look like to get, let me scroll here, $10 million in revenue by 2027. She felt like that was her stretch goal. And at that point, you could garner a successful exit strategy and get the multiple she wanted to get on the business. So as you can see here under case, we've got base case. So this is the idea here was, this is what the business would look like if she did nothing different than what she's doing now. And this is where I'll go into the drivers of the model. And this is what I'm talking about, more like scenario or sensitivity analysis, as well as running cases. So if we follow this base case, this is our case runner tab. And here we've identified the key inputs into her business, which are, like I said, it's an HR consulting company. So consultants, which is what we talked about, units, right? So consultants, and then how in each year, how many consultants would she add? And then a utilization rate, so a productivity measure. How efficient can these consultants get as you hire more? And there's obviously other inputs into that, whether it be, what's the demand side of things. If there's no demand, their utilization rates won't go up. But that was a big input to revenue. And then a billable rate increase is the ARPU. So how much are we charging for their billable rates? Are we going to keep it the same? Are we going to go up? And then here's a client count build. So all this is, I've removed some of the information to keep it anonymous, but this is kind of the nucleus or the brains of the operation, where you're running different cases based off of what you see and what that output does to the model. So, in one case, we wanted, and again, it's important to also note that the expense side of the income statement also flexes with these. So as you can imagine, if you've got, in case number 2, a higher consultant growth, your cogs are going to go up. It's going to take more resources and expenses to recruit and train these consultants, and your utilization, so your productivity measure won't be as high, which is pure profit, as well as your billable rate. You can't charge as much, theoretically, because you're hiring a bunch of newer consultants. Ultimately, so as you can see, there's a bunch of different cases here that are basically um, isolating different variables. And so we present this to her based off of how she wants to grow the business and what she wants to maximize for. So here, if we want to do the higher consultant growth. So what we do is, this is our driver. It's in blue, it's highlighted. We can just tell from that color coding that we know it's important, and it's probably going to change a lot of stuff if we hit it. So here's a higher consultant growth. Well, let's follow it back to the P&L summary. So now we know it's the higher consultant growth. So all that feeds through to our revenue number. And because of that, that's a higher consultant growth versus what she was just doing. We get to that 10 million in revenue. But then we can follow it up by looking on the revenue tab. And here is where a lot of these numbers are being pulled from the case runner sheets. And this is, as you can see, again, I'll just kind of do the formatting because not everyone understands or has different needs from this business, but these are pulling from the case runner tab. So it's referencing the last quarter consultant count of 21, and then it's pulling from the case runner tab of how many consultants are you adding in a period.
So I just want to comment here for everyone watching. This is an incredibly good execution on readability. And go back to case runner real quick. So one, this is probably one of the cleanest kind of case runner, or however you want to call it, whether it's best case, the base case or whatever it might be, in terms of simplicity and being able to toggle between the two and really identifying the growth driver. So this goes to your point about identifying what your KPIs are. And also just the one thing that's very important here is that 2027 revenue number, because when we think about what's our goal, what's the story we're trying to do in your particular client situation, the goal was to get to 10 million. That was a stretch goal. And to be able to quickly toggle the case and not have to go back and forth and then scroll all the way down to 2027 and look at that number saves so much time, makes it so much easier and cleaner. And I just think that's a very good execution of a model that is very intuitive and gives you, a highlight on, what you need to see when you kind of switch, the different cases. And also just the toggles between the assumptions. So you spend most of your time as a founder explaining how you came up with the assumptions. Then it's very easy to just toggle those assumptions in these different cases. and see how that impacts either top line, bottom line, user growth, client growth, average account value, these types of KPIs that might be important to your business. So just want to kind of highlight that. And then also we got a question: how do you come up with a rate change? How do you come up with these various assumptions in the case runner? So basically, how do you come up with these assumptions?
Yeah, that's the $1 million question. So oftentimes you'll look at the rate of change historically, and try and find patterns. I mean, that's what model building really is when it comes to projections, is pattern recognition. Like, what has the cadence of growth rates been? And then you've got to ask yourself why. As quantifiable as models are, where it's driven by changes to forecast with growth rates and whatnot, if it's if the numbers have consistently been growing 10%, but they're doubling their sales force and they're going after a brand new market that there's like zero competitive threat there, then you would have a higher degree of confidence or greater probability that that revenue growth that had historically been 10% goes up, it goes something higher. And then that's where you can sort of triangulate and slice and dice, look at sort of Salesforce productivity or yeah, ACV, annual contract value per customer, and things like that. But it's really about marrying the quantifiable stuff with the qualitative stuff. So a long-winded way of saying it's pattern recognition, looking at historically what's been going on in the business, but then also asking yourself, will it sustain? And if so, why not? Is there something new? Is there something changing that would cause that growth to go up or decrease? And Jason, to your point about sort of having these sort of banners or flags, I think that's a great point, and oftentimes gets overlooked because everyone, like I said, gets anxious or wants to create the world, go super mad scientist and create the world's next model that's going to solve for whatever, which is fine. But if you can't quickly identify what's changing and have that be in a banner format or a call out for someone that's a newbie to your model, it's not going to land as well as you want it to, and certainly won't land as well as what it should given the amount of time that you've spent on it. So I think a good model is complex, but at the end of the day, it is really simple and navigatable.
And we also got a question. I don't know if I have enough time for you to give the full education, but I'm also curious. How did you code the case runners, in terms of like you just put two and it changes the whole thing? Because my pass is like I used to run the entire model and then kind of snapshot best case, worst case, Goldilocks cases, and just kind of have those static because I never knew how to actually code this myself. My old CFO could do it, but I could never do it.
Yeah. Yeah, I don't know if we'll have enough time for that,
Yeah,
but
it's a little complicated, I'm sure.
no, there is a switch function that you can look up, and I mean you can just Google it, but a switch function here that makes this column all with these numbers. So when you change one of these one of these numbers, then the cells that it's referencing will look up and find the relevant driver here. So it's switch function. If you can spend 5 minutes Googling switch function and play around with it, but that is that key formula in Excel that allows you to maximize case runner functionality. And then here, what we've done is I've highlighted these cells so you can see when those variables are changing. So these are the times, and that was based off feedback with the the client, where it's like, okay, this quarter we think, we can add utilization, or usually, halfway through the year when we roll out contract terms. So it's like having that concept, but then also being able to link it with the case runner. So
Yeah.
here, yeah.
You know, we're probably not going to have time to go through the other model, for today. But what I think, some key takeaways are for founders, and you kind of segued into the model pretty smoothly from the standpoint of like you establish the base, the business case. Like the founder came to you with a very specific problem that they're trying to solve for, and they needed help kind of modeling that out. And that's exactly what you should be doing as a founder. You should have an idea of the direction you want to go, because without that, you kind of just aimlessly like putting numbers. It's really hard to kind of think about what you're actually building out when it comes to doing the model. And so I always suggest founders to really think about those KPIs in their business. Consulting is relatively, straightforward, but if you're a set, and there's a lot of really good SaaS models that you can just kind of take off the shelf that you can just kind of start from, that has all the assumptions and KPIs in there. If you're not a traditional SaaS business or a reoccurring revenue business, it can get a little more complex in terms of, transactions, what drives transactions, and, or utilization or usage of your product that triggers certain, outcomes. So every business is different, and it's hard to just go off a template. I'd say probably B2B SaaS is probably the easiest templates to go off of out there. But, Kian, is there any other kind of like tips that you think would be relevant for founders to kind of take away before we wrap things up today?
I think it can be a daunting task, but if you want your business to reach the heights that you think it can, which is why you went into what you're doing, start a model sooner than later. And you don't have to reach out to a fractional CFO or anything like that, but just open up Google Sheets or Excel and start tracking the numbers, and importantly compare it to your projections. I mean, it's like anything in life, whether it be exercising or eating properly or whatever you're trying to do. You set goals and you compare yourself to that goal along the way to see how you're doing, and it can give you positive and negative feedback, but that's what we need. So that's number one, is to set that stuff up sooner than later. And two, I think by having those types of conversations can oftentimes help you objectively evaluate your business, because all of us are super passionate. You wouldn't be passionate about what you're doing, but if you have a model, it's difficult for numbers to lie. So it creates an objectiveness about your business, and looking at it differently, that I think can make you a better operator in the long run.
And I'm glad you share that. And I will say one more thing is, if you're raising money, you need to make sure your narrative and your deck lines up with the narrative and your projections, and really thinking about how that story flows through. So if you say you're making X amount of money, or you will make X amount of money, it needs to be defendable in the deck, and it needs to be consistent. It needs to be up to date. I run into founders all the time where I spend just so much time just like hounding them for the model or the deck, or the model. And that's one of my biggest pet peeves, is when the model's not ready, or it hasn't been worked on, or it's been like kind of deprecated over an extended period of time. Like, invest in your model. If you're not already have the expertise, go out and hire a fractional CFO, or maybe have one as an advisor. That's kind of my go-to. As any business I start, I always bring on a CFO as an advisor, to kind of have a little bit more stake in the business, and in those early days, give them shares as opposed to cash. But when you kind of get to a certain scale where you need someone dependable that's committed, starting with a fractional CFO, or at least getting like a bookkeeper, just to kind of keep your book straight on a monthly basis, is such a value add to your business. And not like, I have some companies that like, oh, we're going on to raise money. It's like, all right, show me your books, and they're like, well, we haven't started on that yet. I was like, right now, get a bookkeeper right now. Just get the books updated, because and squared away with someone that actually knows bookkeeping. Don't have The founder should not be doing bookkeeping, in my opinion, ever. That's like the biggest waste of time, unless your business is selling bookkeeping. So with that said, Kian, I really enjoy having you on the show today. For anyone that wants to reach out to you, I think just going to chelseacapital.com would be the best path, correct?
Yep, that would be best.
Awesome. And so I'll put that link in the show notes and the recordings, and we'll send everything out, and I'll put your information, Keen, in case they have any follow-up questions for you. but that's chelseacapital.com. We use them for our bookkeeping services, incredibly helpful, and have done a great job. Run, as you can see just from the presentation quality of their models, it's a tight shop and run pretty well. As always, if you guys need help with fundraising or have any questions on fundraising or what VCs might be looking for in the fundraising, game, don't hesitate to reach out to me. You can hit me up on LinkedIn, Twitter, email, all the above, or that little chat on our website, thunder.vc. But with that, we'll go ahead and wrap. And, thanks everyone for joining us. Appreciate the good questions. And, oh yeah, sorry, it's Chelsea.capital. Oops. Good catch. We'll put it in the notes later. I forgot. I knew I was messing something up. But we'll go ahead and wrap. The recordings will be live, soon, and we'll also be following up with everyone that attended with a link to the recording in case they want to reference it later or share with a co-founder or a partner or anything like that. But again, really appreciate you being on the show and sharing your insights.
Yeah, thank you very much for having me, Jason.
All right. Thanks, everyone.